All right, there we are. Look how handsome we look, Tellis. What do you think?
You know, I upgraded the camera on my laptop just for this. So
the audience appreciates it. All right, ladies and gentlemen, welcome to the Live from the Compound. My name is Downtown Josh Brown. My guest today is someone I've been trying to get on for a while. He's a great writer, great reporter. Tellis Demos is writing for Heard on the Street, which is, I would say, the most vital column, for me at least, at the Wall Street Journal, where I read pretty much everything he publishes. He is also the co-host of Wall Street Journal's Take on the Week, which is a weekly podcast about markets and finance. You might recognize his co-host, Gunjan Banerjee, who's been on our channel before. Tellis covers the world of money and banking, too big to fail banks, Wall Street itself, private markets, crypto, insurance, mortgages, credit cards, financial technology, and more. Welcome to the show, Tellis. Thank you for doing this.
Thank you. Hearing all that said is just like stressing me out about
No, don't be stressed.
How many things they asked me to write about.
Well, you're a polymath when it comes to financial media. Like you got the gamut. So, I want to start with these. I want to start with the I don't know what you would even call it. I was going to say acquisition, but it's sort of not. It looks like the federal government and China have reached some sort of an agreement where TikTok will spin off its U.S. operation into the hands of Oracle and a consortium of other players who will take over running a new version of the app. It sounds as though we'll be licensing the technology from ByteDance, which is the Chinese company that will no longer have access to U.S. users, but they will be paid for, I guess, the tech transfer itself. And then Oracle's going to hold on to all the U.S. user data securely in a U.S.-based cloud data center. And it'll sort of be like rebuilt as like a U.S.-only TikTok app. Is that the journal's understanding of what it looks like so far, what we've heard in public so far? And would just love to get your thoughts on the uniqueness of something like this.
Yeah, I mean, I think there's, you know, we've reported, the journal, that a deal has come together, and I think what's interesting is that it's not. I don't want listeners to come away with the idea that because the government is sort of obviously playing a role in sort of brokering this, that it's necessarily going to be then, you know, some extension of the government. There are a consortium of investors who are coming into it. Some big names, Silver Lake. I don't know, you know, people know the private equity industry. That's a name that I'm sure people will know. You know, they've long time, you know, major like tech and financial too, investors all over the place. Oracle is going to play a part of that. I also just have to flag that according to our reporting, I'm not giving any inside information here, but according to our reporting, what I read in the Wall Street Journal is that Lachlan Murdoch and Rupert Murdoch will probably be in the ownership group. That's something that Donald Trump said on Fox News on Sunday. He's named Michael Dell as well. And so I should just say that Lachlan Murdoch is the chair of News Corp, which owns the Journal. And he's also chief executive of Fox News parent Fox Corp. And what the Journal said, and I'll just read it here. I don't want to get myself in trouble. A person familiar with the matter said any investment in TikTok would come from Fox Corp. So just want to flag that for everybody that you know, there's some crossover there. But I mean, look, it's a deal that shows you that, like, it's funny when we talk about like companies that are in the social media business today, we almost never talk about their like social media businesses anymore. When we talk about Meta, we're talking about like, you know, what are they doing in AI? How are they going to, you know, sort of drive that future? But I think, you know, the fact that everyone's so interested in TikTok it's just a reminder that like this is still where we all live our lives, you know, and young, old, I don't care, you know, the power users of TikTok I know are like middle-aged people who are just trying to like zone out at night and like they like that they can just scroll. They don't even have to like pick something to watch. They just scroll, right? And so I think it just goes to show you that like the interest in that deal is so high. Obviously, there's big politics, but it's like it's a daily life thing for a lot of people, right? Like I don't know. I don't know if do you use TikTok?
I have an account where I think Nicole from my team posts clips of some of the stuff we do here.
So you're on TikTok. but not
Yeah,
of
but I
TikTok.
don't. I
Okay,
don't
okay.
scroll it. I don't watch it. I
Yeah,
haven't. I'm already brain rotting with Instagram. I don't need like
yeah.
four more versions of that. Um, I guess. I guess what. I guess what's interesting to me is that there are two political issues with TikTok. One of them is user privacy. Like it's a foreign-owned company that is gaining access to. All right, so it sounds like the Oracle thing would solve that. If it's being hosted here and the
Right.
Chinese will lose access to,
That's the
I
idea, I
guess,
guess.
coming in through a back door and seeing what US users are up to. Okay. And then the other thing that I think this solves is like the foreign influence, like just, what is the algorithm showing people in the wake of a crisis, for example, October 7th or the Charlie Kirk murder, or like what is then being amplified to the 35% of all US 18 to 35-year-olds who
Yeah.
say TikTok is my primary source of news. That's an actual stat. It's more than a third of young people consider TikTok to be where they get educated. So
Yeah.
not having the foreign influence on what the algorithm is surfacing, I feel like gets solved by having now. It's a consortium of U.S. companies. Ostensibly there's some political spectrum involved, no matter who's going to run it. But like, I feel like that's like one way to really easily clean up that issue. Um, then there's the
Well, and
financial
but I mean,
side. Oh, please.
to emphasize your point, like we've been talking, obviously, like late night shows have been in the news. I don't think I need to explain
Right.
to people why, you know, but to an extent, like, I mean, is that really where people are getting their views from, right? Is a late
Not
night
anymore.
host
Right.
who is, I mean, I think at that, by the time you're getting to like, oh, I'm watching somebody say something on late night, you've already been inundated with content from seven other different places, right?
Yeah.
And so I think, I'm not surprised to see the TikTok content recommendation algorithm, which again, according to journals reporting, a new version of that would be retrained, I guess, in this deal. And I'm just not surprised to see that's a political football of like what is
Yeah.
that push and what is that not, and
Who's retraining
and
it?
I mean certainly in my industry, right,
Yeah.
it's the media,
Right.
is only, we're sometimes a passenger in some respects when it comes to like what do the different algorithms sort of do. So I'm not surprised to see that's
If you're
a
Mark,
hugely,
if you're Mark
kind of
Zuckerberg,
debated
what do you
issue.
is this good or bad? It's a competitor to Reels that 2 years
Yeah,
ago looked like it might get banned off the face of the earth. All right, now it's not only not going to be banned, but it's going to be a U.S. based corporation that competes directly with Reels. So from that standpoint, maybe not great on the advertising side of the business. It's a real competitor.
do I have to say like maybe I just like me being like a relative like grandpa of like social media, so I'm not the savviest sort of
Yeah.
user of it, but it's like I feel like every app I open now kind of feels like TikTok. Like as a matter of fact, I was flipping videos, kind of like you would on TikTok, right? Like next, 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 scroll. And at some point, I realized I was not actually looking at TikTok. I was looking at what I think was like I just sort of stumbled onto that the kind of the vertical video feed of Facebook. And so,
Yes.
and to be honest, like just again, I'm speaking for myself as just like a middle-aged user of these things. Like it's like I do think there's maybe kind of we're reaching the point where like I don't know what platform I'm on. I just know that I'm watching. And I think and I by the way, like
Well,
I see the same
LinkedIn has it
content.
now, and
I think so, but they probably
YouTube
do.
has
Yeah,
Shorts.
yeah,
So yeah, to your point, like everything looks like
yeah.
TikTok now.
And the same content, like I see the same creators kind of pushed into different places, right? And I think people like I remember the joke about Reels, what it was that it was like, oh, Reels is like where people go to see TikTok 6 months later, right? so
Right.
so I think at the end of the day, how much does like one particular algorithm drive the conversation versus like the constellation, of
Yeah.
of all of them. So I think maybe the future is actually kind of maybe the biggest worry for Mark Zuckerberg is just maybe the future is a little bit like agnostic to that, right? Like I know I get it on my device, and which service
Oh, that's so
serves it
interesting.
up to me.
Like
I don't know.
as long as the viewer could do this and just scroll
Right,
up, up, up,
right,
up, up,
right.
they almost don't care what platform is facilitating that. As long as the algorithm is good enough to keep people's attention. All right, I agree with that. We're going to make an extremely hard pivot because you've been writing a lot about rates and mortgage rates, and I actually think so. I'm an equity investor primarily, and so I actually think the most exciting potential thing that could happen heading into 26 is a true recovery in the housing market. And of course, that's not going to happen unless mortgage rates actually fall. They don't need to plunge. They just need to continue on their recent, let's say, last 3 months, last 4 months, that kind of gradual descent that we've been seeing in mortgage rates. And you've been writing a lot about it. So let me set you up here. You said long-term bond yields have been drifting lower because of a host of factors, including expectations the Fed will start cutting rates. Okay, we did that last week. The corresponding move in mortgage rates has been stunning. A daily tracker reported the 30-year fixed rates hit their lowest level since 2024. We're at 6.29% this past Friday. And on the Friday of the most recent government jobs report, which was a slower than anticipated pace of hiring, the 10-year fell 0.09, which is a pretty steep one-day drop-off. You also point to the spread between Treasury yields and mortgage bonds, which is falling as well, which is important. So I'd love for you to just kind of give us your take on what we're seeing in that mortgage market and whether or not you think this is leading to the type of scenario that could unfreeze the housing market materially.
Well, I mean, just to start with that last question, like, I mean, there are, what could unfreeze the housing market, right? What could get people buying and selling again? I mean, you either have to have a big adjustment in the price of houses, right? Which is, for homeowners kind of an ugly idea, right? Like basically like, oh, well, home prices have to get cheaper, right? Well, that takes money out of a lot of people's pockets. So that's not really necessarily a fun thing to think about. You could have people making a ton more money, which I guess is the best case scenario, right? Like everybody's just making a lot more money and then mortgages are more affordable.
Unlikely right now. Okay.
That's and by the way, these scenarios were kind of like I think one of the big mortgage guarantors, I think it was one of them, kind of laid out these scenarios. So this is not an entirely original thought, but then the other thing would be mortgage rates, right? Do mortgage rates come down meaningfully? Like not just like from 5.5 to 5, but like from 5.5 back to the world of twos.
Yeah.
And so will any of this move the needle on like affordability? I don't know if we're talking about a move in mortgage rates, except in like an extreme scenario that like really changes that conversation, right? So I just want to level set there. Like I don't think that any kind of move that we're contemplating in just from the scenarios we're talking about here.
Seven to five is meaningful.
It's meaningful, but it's not
Yeah.
going to bring those affordability numbers back to and I'm gonna hold on. I want to credit. Let's see. Give me 1 second here. This is I was reading a Twitter account. News Lambert. Lance Lambert was kind of finding something from Fannie Mae, kind of talking about these things, and to get back to pre pandemic affordability levels, you'd be talking about, again in this calculation, a move back to from 6.5 to 2.23%. Right.
Also unlikely outside of a financial crisis.
Right.
Okay.
The series of events that lead to that are pretty extreme. Right.
We agree.
So I don't think affordability is going to change. However, like certainly at the margins, right, I do think that there are some scenarios in which mortgage rates start to come down. What I was writing about, talking about that stunning move, was just sort of noting that look, I don't know how many people follow the mortgage market that closely. I didn't really understand what drove mortgage rates until I started writing about this. And there's the world of the mortgage rates that you see, right? You call up a bank or you look at like one of the comparison websites and they give you a rate. That doesn't come from. That's not like a Fed funds rate plus kind of thing. It's a rate that's set by a market, and that market is the mortgage bond market. And so when you make a mortgage loan, it then usually gets sold into the mortgage bond market. So what's going on with those bonds affects the prices that you might see that get reflected in rates.
Right.
And what was happening there was, and this was being tracked by Mortgage News Daily. I don't know if most people, when people talk about mortgage rates, I think they usually are talking about the Freddie Mac PMMS. I forget what that stands for. The Primary Mortgage Market Survey. I'm pretty sure. And that comes out on I think on Thursdays, and that's backwards looking, right? So you're kind of getting, well, where have mortgage rates been heading into this day? There are some daily measures of that, and one that I've cited in my work a few times is Mortgage News Daily, and so what they were noting was that what happened was there was this essentially kind of air pocket in the mortgage bond market. I don't want to bore everybody, but the way mortgage bonds work is like the bonds have a kind of a different coupons, and so they come in half point
And like
increments.
buckets. Yeah.
Buckets, right? So the 6.5, the 6, the 5.5, and every mortgage kind of gets sorted into one of those. And so what was happening in that particular, this was after the jobs report a few weeks ago, where you saw kind of 10-year long-term yields, which is really where kind of mortgages are more priced off of, because mortgages, you take out a 30-year mortgage, but a lot of people move or refi, and so a 30-year mortgage ends up really having more of like a 10-year-ish duration. Somewhere between 5 and 10 is kind of what people talk about. So that's why the 10-year treasury is a real reference for that market. And
the 10-year treasury is more powerful in terms of having the 30-year mortgage rate react to it. No, it's not overnight rates, and it's right.
If you want a quick guide to what's happening in mortgage rates, look at that 10-year treasury.
Well, let's put this chart up. So this is from your article. So this is the yield spread between agency mortgage-backed securities, current coupon, and benchmark U.S. Treasuries. And that spread has been falling, meaning the MBS products that people can invest in, the yield is getting closer to what, I guess, the benchmark U.S. Treasury of the same maturity looks like. So there's a credit component to that. But I think, Chartoff...
A little bit. I mean, agency mortgage-backed securities are the ones that Fannie and Freddie and other,
they're pretty much money good.
Sponsors. Yeah, exactly. So there's a little bit of credit, but not a lot.
You're making this point, though, that I think is really interesting, which is the institutional buyer of a mortgage-backed security. So one of the big risks to them is prepayment risk.
Right.
So in other words, they invest in a bond which is backed by mortgages, but a lot of people that own those mortgages, the nominal rate of the mortgage is so high that those are the first people who are going to refinance lower. When they refinance lower, they prepay the mortgage. The problem for the institution that invested is they thought they had all these years of high yields coming to them, and the bond has just been, the income is being taken away because the person prepaid. Yeah. So as a result, you've pointed out there's actually more popularity from investors to buy the lower nominal yield, the 5%, let's say, mortgage bond, because there's less risk of that prepayment. And so that's that air pocket that you were describing.
Yep, exactly.
And that in turn has an impact on the rate at which banks will make mortgages. Who can they sell it on to? It really matters that there's a buyer for that MBS.
Yeah. Yeah, no. So it's like all of a sudden the market's mindset shifts to I got to protect myself against prepayment risk, right? I've sold this option to homeowners that they might exercise to refinance their mortgage at a lower rate. And so, okay, I'd rather buy something that has a lower coupon or yield, but I think will actually last, for a longer period of time. Because otherwise I run the risk that if too much of my bond prepays, I don't lose money, right? I'm getting my principal back, but it means that then I'm sitting on cash that for a certain
you have to invest
investor,
at a
you got to
lower prevailing
reinvest
rate.
that, right?
Yeah.
And then the prevailing rates are lower, and so then you're like, okay, well, if rates are on their way down, so really this is all partly about the market's expectations of the way rates are headed, and so what's really underlying all this is a sense that despite everything we've talked about, we kind of, I know in the media sometimes in the financial press, we get kind of like, all right, there's a new narrative, and that's that like treasury yields are surging, right? There's like a
Yeah.
day when the 30-year hits 5%. We all, oh, okay, all right. What if
Right.
rates keep going up? And are there long-term concerns about the U.S. fiscal health, right? Are people not going to want dollars because of tariffs
Right.
and all that, right? We get, but then what happens is that, a couple pieces of economic data come in, they're not so hot, and like some of the same old kind of muscle memory kicks in where it's like, okay, well, that means that the Fed's probably going to cut, so that means that I should buy today's bonds at this yield because yields are going to go down and blah blah, or flight to safety, right? Okay, oh, I'm going to cut some of my stock allocations, move into bonds, etc. So we saw the return of that dynamic. As the once we started getting a couple of like not so great economic data points, and so then you just had this kind of like then like basically the battleship turns, and a lot of people in the market start running towards the okay, if rates are on their way down, here's how I've got to kind of
But it
protect
turns
myself
really
against that
slow.
risk.
It
Yeah.
turns really slowly. And institutional investors, when they get into a mindset that, you know what, we're actually more interested in buying the MBS at 5% versus 6. 6 is a better interest rate, but more prepayment risk. Like that battleship, once that turns, it's not all of a sudden going to turn back around because of one piece
Right.
of economic data.
Yeah.
So I think that's a really good point.
Yeah,
And
that
it's
sounds right. Yeah.
and the self-awareness that you have as a journalist, just understanding the tendency of journalists to be like, we want a new story to tell because it's a new day. There's not always a new story to tell. And
Yeah, I mean,
I know
I
that's
wouldn't,
like a
it's not
constant
just
push
about
and
the,
pull.
yeah, I mean,
Yeah.
it's not just about the news story. I mean, but it is like, we kind of have to be like, I mean, I would say that at least the way I think about it is like, all right, something new or dramatic is happening. I can't tell you that it's going to necessarily keep happening, but I feel like
Right.
if I don't note it or think about it, then if things really do head in that direction, I don't want to be in a position where like I kind of was like, oh no, this things will never happen that way, right? It's like my version of like market timing. It's like saying like
Yeah.
I'm not going to write anything about 5% yields on the 30-year because I think they're going to come down, right? I don't know, like I'm doing my
Right.
best like everyone else to figure out what's going on, and so I want to I think sometimes the right way to consume, financial media is not that we're making a call, but that we're trying to just like prepare ourselves and our readers for like, all right, if the market takes this to its logical conclusion, whatever, right? If
Right.
they keep pushing on that, then here's what happens at the end of that. And maybe we don't get there, but I would rather feel prepared as a journalist, and to the extent that I'm providing a service to readers, just kind of flag for them like, all right, here's what's on that side of it. So
Yeah, I think you're chronicling it and you're opening up the door to possibilities based on what's happening and not saying, all right, this is what's going to happen next, but you should be aware that historically when A, B, and C line up, D is normally the outcome or has sometimes been the outcome. I think that's the thing. And if you do that well, you let people make up their own mind and come to their own conclusion. I want to show you a chart we made for this. This is 10-year treasuries versus the 30-year mortgage rate. And my guys, Sean and Chart Kid Matt, noticed the average spread since the year 2000 is 1.88%. The spread has now been above that average since March of 2022. But like these lines largely mirror each other. There's very little deviation here, especially over we're showing you the super long term, 25 years, but you will very rarely see a huge deviation between the 30-year mortgage rate and the 10-year mortgage rate. At times, the spread may be wider than others, but so when you said it's really the 10-year that you're looking at, if you're trying to understand the forward course of the 30-year, this is exactly what you're saying, but illustrated by us. Thoughts on this?
yeah, I mean that spread has really been it's really been the conversation, I think, in the last couple of years, because when so as people may know, the Federal Reserve was for many years buying mortgage bonds, right, as part of they call it credit easing, quantitative easing, whatever you want to call it. The Fed was in some ways, helping keep that spread really narrow by being a big buyer
Yeah.
of mortgage-backed securities, agency MBS. And so when the Fed stopped doing that, a couple of years ago, and started letting that portfolio run off, like I think, most strategists, investors I've talked to, have attributed, some of that spread widening to that, right? Just a big buyer coming out of the market, and to some extent banks, were in the same position, right? Back when, rates were near zero, they were like grabbing anything that had a little bit of yield, including mortgage-backed securities. We know that got some of them into trouble back in 2023. So banks have not necessarily been big buyers either. And so you have seen a widening, but it's not to like such a level that I would say that on a long-term time horizon that those two charts, like all of a sudden you see mortgages going like this and treasuries going like this for a long time.
Right.
But it does, and so I think that there is the potential for some of that spread to continue tightening. Just take again, it's not going to drive mortgage rates from 6% to 2%, but it will maybe shave some fractional point off of that. Listen, every we all know as home buyers or whatever, every eighth of a point matters, right? That's
Well, I
money
think
in someone's pockets. So,
I think the bigger
it's something
story
to watch for still.
and you guys did a feature on this. I don't think it was part of Heard on the Street, but there are millions of households where for every 50 basis points in the 30-year mortgage rate, it's like a new tranche of households, it would make sense for them to refinance. And I think the Journal stated it as rates would have to be 75 basis points or more below the new mortgage rate in order for the financial incentive to kick in and a household to say, okay, now is where it makes sense to refinance. So having millions of new households all of a sudden be in a position to refi is also, it's not just about moving houses, it's about unlocking liquidity.
Though I will say where mortgage traders kind of like make their money, like, right, the difference between somebody who's good at that and not or whatever is like really being able to kind of have a view on that prepayment rate, right? Because there are things that affect that, like, for example, like if people, maybe you could refinance, you have an incentive to refinance, but maybe something's happened to you that, like, your credit's not so good anymore, right?
Right.
Or, you can't pay the upfront costs, right? Because there's some out of pocket that you pay. So I think people taking a view on the prepayment speed, right? And by the way, other things I've read before, and again, this is outside of my expertise, but like, what people in that market talk about is like, okay, a lot of the market is, what's the prepayment speed of a first-time home buyer versus somebody who's not, right? I think, sometimes people think that first-time home buyers prepay at a lower speed, right? Like they're less likely to refinance, within the
younger,
first couple of years,
lower
right?
income, right?
Yeah.
There might be a lot of
some
reasons.
Some of it too is like, also like, is there an anchoring effect, right? Where like people remember 3% mortgages. It wasn't that long ago. Somebody, their neighbor, the person who sits next to them at work, they've got 3%. And so they feel like, oh, should I really be excited about 5? Like, even if there's like a meaningful incentive, you're kind of like,
Right. I'm going to wait till
5
they're
sounds
back
good,
at
but
3.
4 sounds really good. I think one thing too that like that investors in that market are thinking about is like, what is that prepayment speed going to be? And anyway, just to let people a little bit of inside baseball there, like that's part of what people think about.
Yeah, one interesting thing that you were talking about is that sometimes the rates don't behave the way that you think they will, and we got a really great example of that last September. So the Fed surprised the market. They did a 50 basis point cut rather than a 25. Then they waited a year to cut again, but that's another conversation. But they do this 50 basis point rate cut, and then what happens? And this is you. The Fed surprised markets by lowering its benchmark rate by 0.5% at the September meeting. Over the next 2 months, the 10-year Treasury yield rose by about 0.5 percentage point, and average mortgage rates jumped about 0.75 point. So the bond yields didn't cooperate with what the Fed was doing with overnight rates, and the mortgage market certainly didn't cooperate. And so that's a thing that happens. And so even if the Fed does deliver 2 more cuts this year or 1 more cut or whatever it is, to your point, we don't know for sure that there is some sort of definitive read through to how the rate of the mortgage market will behave.
Yeah, I mean, there's so much that goes into whether or not people are buying or selling at that longer kind of the belly or whatever you want to call it of the
Right.
treasury curve, right in those fives and tens, which is again where kind of mortgages are sort of to some extent priced off of like that depends on people's views on a million different things, right? The economy, politics, etc. Right? So the Fed cutting now. As a matter of fact, you could even see a scenario where like if the Fed cuts like super aggressively, that spooks people in some different way, right? About
Yeah.
like the direction of the Fed overall, and is the economy going to go overheat? And is there going to be
What do they know that we
inflation?
don't
And
know? Yeah, yeah.
yeah, so and so then you see people kind of like what do you call it, like a bear steepener, right? Where people are like, oh, this isn't good, I need to sell, so I don't know, maybe I mixed up those terms, but like but what the 10-year Treasury does is only somewhat related to what the Fed does at its next meeting.
I want to get to one more thing before we let you go. You've been talking about J.P. Morgan and its ambitions in the credit card market, and I thought this was a really great piece you did. So you say that they are already number one in card spending, and they want to be even more dominant in this business. Last week, we found out there's new pricing on the American Express Platinum card. Also, a lot of new features that are going to come along with that. But on the JP Morgan Chase side, it's about the Sapphire Reserve, and they've been making a bunch of acquisitions, acquisitions that steer people toward more ways to spend money on trips, on restaurants. What do you see happening in this market, and why do you think it's so important to JP Morgan right now?
I think what struck me and what got me interested in that was just seeing how here's like America's biggest bank by most, if not all, measures.
Yeah.
And here they are, like really kind of investing heavily in a business that I think people think of as like, oh, it's got its up, right? Like credit cards, like, oh, there could be loss, the consumer loss is there, right? It's really competitive, etc. And and then I think you just started to see it, like we see it in our lives, right? Like the we read about like the relaunch of like the Sapphire card and its fee and the value add, and
Yeah.
American Express does that too, and Citi has a kind of premium travel card, Capital One is, and so it's like what I wanted to just sort of write about was just like this is a big business, and it's really important for even a bank as gigantic as JP Morgan Chase, just because it's I mean the credit card business can be a really good business. Like not only
Yeah.
does it itself make money, right? And that's partly through the interchange fees that banks collect when you swipe your card, the kind of merchant fees we sometimes call them. Now some of that gets essentially like rebated back to people in the form of rewards. But it's still that's a lot of money kind of moving through the banks, and they have partners, right? All the companies that participate in those rewards, like they want to be in on that, right? They want to have that customer loyalty, so
Yeah.
and the bigger you
If you're
are,
not doing
the
it
more
with them,
scale.
you're doing it somewhere else. So
Exactly,
they want you to do it with them.
exactly.
You pointed out J.P. Morgan Chase credit card sales volumes, just so people have an understanding of like the raw numbers involved. And this is excluding corporate cards. This is just people using things like the Sapphire Reserve and some lesser cards. But that number pre-pandemic is just below $200 billion. And as of the latest reading, it looks like you guys have that number now just shy of $350 billion. So that is one of the fastest growing businesses within banking, period, full stop. And you could understand why, if you're consumer facing, it's like you have to win there. And they certainly appear to be trying to win it all. What do you think?
Yeah, I mean it's and if you think about it too, like it's a feeder into all kinds of other banking businesses, right? Like if you've got someone's credit card, right? You can obviously maybe you might have their checking account too, or have a shot at that. You could pitch them a mortgage, and then like I said, you've got the merchants, in there too, right? Like you've got people who want to make deals with you, who want to do business with you, because you essentially are this funnel of money, and where you point people, can be very meaningful to a merchant, right? Like like I think one thing I've learned is that when you're listening to the earnings call of like American Express, you've also got to be listening to the Delta earnings call, right? Because those two have been, they have a major business together, right? And
Yeah.
so like, and so I think people just really need to appreciate like how just the amount of money and just like the nexus of kind of like business that happens, with credit cards, right? It's not just like this like thing in your pocket. It's a huge business, and even for somebody of the scale and stature JP Morgan Chase, and also just that like it shows too like how Chase, given its size, can really be a fierce competitor in here, where they can deploy so many resources to making their cards attractive to users. Like that's a tough competitor too.
So so to that end, and I'm a shareholder in JP Morgan Chase, just full disclosure, but you point out how JP Morgan has the ability to make investments here that pretty much nobody else does, and that ultimately becomes an advantage. They just don't have people asking them about how they're spending their capital and how they're investing to the same degree that other banks might. And this is to quote you, the market has a high degree of trust in how JP Morgan spends its money. Unlike many lenders who can afford to be patient with the profitability of investments. You talk about the return on tangible common equity, 21% in Q2, well above its through cycle target of 17. It's the highest among the big six U.S. Mega banks. And they kind of are in this place where they can make investments and allow more time for them to pay off than many other banks that want to issue credit cards. And as a result, they can win more customer business through those incentives. And the bigger they get, the more benefits of scale that come later as sort of like a longer tailed benefit to the company itself and its shareholders. It's a pretty unique circumstance that they're in.
Yeah, I mean, they have a profitability cushion, just given how high their return on tangible common equity is, which is kind of a benchmark I think that a lot of investors and that the banks themselves use to kind of look at their kind of core profitability. That is like how well does their capital turn into to profit, and so they can just, I mean, it's like classic, right? It's like they could put a loss leader out into the market that sort of like just
Right.
either grabs them share or not, and so just thinking about them as a competitor is tough, and that's not to say that other banks don't have like compelling credit cards out there, right? Like, but it's just like it just seems like, and just talking to analysts, this is a view that came up. It's like there's when they're sort of saying, okay, we're going to invest in our card business, the market's kind of like, oh really, like how much are you going to spend, how long are you going to do that
Right.
for, like what's the whereas with sometimes it feels like just looking at the way JP Morgan trades, it's like, oh great, oh wow, they're investing more.
Yeah, you
Like,
got
that's,
this.
That's
We trust you.
That's a good sign, right? And I mean, JP Morgan's not the only business that has that, but it's like
Yeah.
that's a good place to be, and it may be kind of unique in banking. So now we'll see, right? I mean, cards are not a riskless business. If there's a
Right.
huge recession, borrowers can be exposed. Now, again, Chase, and this is true of most of the big banks. They try and play in the more kind of like prime, super prime part of the market, so they're not lending to people that they think are at big risk. But credit risk is credit risk. And then also, again, playing the rewards kind of race, running in that race with everyone else is expensive. You've got to be offering
Yeah.
people, they're raising the fee, but they're also giving more, kind of benefits, right? Like more credits and other, the point totals and stuff. So, so it's not like, you have to be able to see through all that and to say, okay, we still think that we're going to be, that this is a profitable business today and will be in the future, right? Like if you just buy market share, we know that's not necessarily like a road to success. So so it's not, we'll see if these things pay off as anticipated, but yeah, cards are just. And I think right now is a really interesting time. Like I said, people probably seen the marketing for all the different, kind of card brands that they know that, the
I still never, I still never never got the call.
Capital One.
Yeah, I never got the call with U.S. Open tickets from Amex Platinum. I don't understand somebody's getting that call. It's not me. So, all right,
You got to spend more. You got to spend money to make money, Josh.
Yeah.
I don't know if you know.
Tell us, this has been so much fun. Thank you so much for joining me. I want to let people know where they can follow your writing and your reporting. You are at Heard on the Street with WSJ. And then the podcast, tell people how they find the podcast. What's it called?
It's called WSJ's Take on the Week. It comes out on Sundays. We focus on like markets, business, finance, trying to look at what people are talking about in the markets and what's coming up. So it's a good, listen to it on Sunday mornings to kick off your week.
It's a good Sunday morning listen. All right, tell us, the man, thank you so much for joining us. We appreciate it. Thanks, guys, for watching and for listening. We'll talk to you soon.